Good morning and welcome to the 10 Entertainment Group PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab, which is just situated in the top right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll.
Good morning and welcome to our 2021 results update. I'm Graham Blackwell and joining me today is Anthony Smith, our CFO, who will help me guide you through our results presentation. Turning to our agenda on page 3. Anthony will later take you through the financial details for 2021. However, I will start with some highlights of what has been a remarkable year of recovery for the business. Although we were closed for the first 38% of the year, we reopened incredibly strong and have returned the business to profit for the full year. The numbers show a full financial recovery and we have restored the business to a positive cash position. I will then provide an operational review, setting out the progress we have made in 2021 and how that will accelerate during 2022. Anthony will then end by giving an overview of our outlook for 2022, which we think remains positive despite some of the challenging external factors. We'll be happy to take any questions that you may have at the end of the presentation. Turning to page 4. 2021 marks a return to profitability for the full year, with a profit after tax of £4 million, despite being closed for the first 20 weeks of the year. Just as importantly, we returned to sustained and strong cash generation. It's also been a year of records. Since we reopened in May last year, 96% of our centres have delivered their highest ever week on record. We had our strongest ever weekend and have subsequently surpassed it a further 7 times. We enjoyed a record-breaking October half-term trading, only to beat that in February of this year, and during the summer holidays we experienced like-for-like sales growth of 57% compared to 2019. As a result of this, we returned to our investment programme. We completed refurbishments of 4 of our centres during 2021, Nottingham, Plymouth, Bristol and Kingston. Each of these included adding ancillary games to broaden the customer experience and completely refreshed and modernised the experience for our customers. We've built a strong pipeline of new centres and I'm pleased to say that we are just about to start construction on our new centre in Walsall in Birmingham. We expect to finalise an acquisition shortly and we have 6 more centres that we would expect to open in the next 18 months. We're in the sweet spot of the growth in experiential leisure, offering an affordable and accessible competitive socialising experience that has stood the test of time. This is exactly where the market is growing and meets the ever-increasing demand from consumers for fun, engaging activities to enjoy together. We're carrying strong momentum into 2022 and are looking forward to another strong year. Moving to page 5, I'd like to give you some financial highlights of 2021. Total sales of 67.5 million were 86% higher than in 2020, reflecting how far we have come in managing to live and trade under COVID conditions. The business was open in 2021 for 62% of the year, but still delivered 80% of 2019's full year sales, showing a remarkable like-for-like sales growth of 29%. We were delighted to offset first half year losses while closed with a very strong second half. We generated an adjusted profit before tax of 3.1 million for the full year. The turnaround and momentum is brought into focus by comparing the two clean periods of H2 2021 with H2 2019. EBITDA of 26.4 million for the second half is a full 43.5% higher than the pre-COVID trading period. Testament to this financial performance is seen in the bank net debt of only £2.5 million, which is lower than it was before the pandemic. I'll hand over to Anthony now for the financial review.
Thank you, Graham. We'll start on page 7 with an illustration of how the sales have evolved. This chart shows the sales performance of the business over the course of the past 27 months. You will recall that in the first quarter of 2020, we were trading strongly, delivering like-for-like sales growth of plus 9.6%. 2 years ago, we entered the first of 2 full lockdowns, both of which meant that we delivered no sales for a period of 46 weeks in total. Between the 2 lockdowns, trading was challenging, but initially with 50% lane capacity, we were very pleased to see sales at 77% of previous levels before partial lockdowns returned in the autumn. This was the first indication that underlying demand was robust and that we had a model that was extremely popular with customers. This note of optimism has been vindicated by the strength of our reopening since May 2021. Trading started with some remaining restrictions until Freedom Day on the 19th of July. Nevertheless, we were still trading at plus 17%. The removal of those restrictions coincided with the start of the school summer holidays. We had a remarkable sales performance of plus 57% during that period. No doubt this was helped by staycations and pent-up demand, but the underlying growth is evident. Perhaps even more encouraging is the resilience since those summer holidays. Plus 23.5% in the final part of the year was slightly suppressed by a brief but marked drop-off immediately before Christmas as Omicron threatened the festive season. But the acceleration to 41.7% for the first 12 weeks of 2022 shows that 2021 was not simply pent-up demand, but a shift in consumer behaviour. In the 44 weeks since we reopened on the 17th of May 2021, our like-for-like sales have been plus 32.7%. This is not all temporary, this is structural. Our growth has been far ahead of most other operators in hospitality and leisure, particularly pubs and restaurants, and we will continue to build and improve the customer experience to ensure that we maintain this new level. Now, turning to page 8 with a breakdown of the sources of that sales growth. On this chart, I'm comparing 2021 sales from the 17th of May to the sales in 2019 over that same trading period. 2019 is still the last full and complete year of trading before COVID, and so we'll continue to use this as a baseline for comparison purposes. Our strategic focus has been on business improvements in customer service, food and drink, and enhanced digital and physical experience. The impact of this focus is clear on this chart, with £12 million of sales growth derived from increased footfall and £2 million from increased revenue per head. In total, this represents almost 28% of the 29% like-for-like. We did benefit from the reduced rate of VAT, but because this applied only to food and non-alcoholic drinks, the impact of plus 2.7% is far less than seen in other sectors. For 2022, this will reset to 20% from the second quarter. Our pricing strategy has been key to success. You'll know that we operate a tariff rate at peak periods, which we don't discount. We overlay this with promotional incentives, packages and deals to manage our yield and capacity into less busy periods. For example, a regular 50% discount on 10-pin Tuesdays or a weekday summer holiday deal of bowling and food. During 2021, we held our tariff price stable and continue to offer great deals. A consequence of customers mixing into those off-peak periods has been the average realised price of a game of bowling reduced slightly in the year, but we have benefited from increased footfall and ancillary spend and delivered an overall 29% increase in like-for-like sales. The growth from new centres relates to Southport and Falkirk, which were acquired in mid-2019, and Manchester Printworks, which opened in 2020. Turning to page 9, I have shown here the recovery of our cash position back to pre-pandemic levels. At the end of 2019, we had £4.1 million of net debt. We had reduced this to nil by the time of the first COVID lockdown. We were single-minded in our approach to cash conservation and worked hard to limit the outflow. In January 2021, we secured a £14 million term loan under the government's CL Bills scheme to provide an additional buffer to assure sufficient long-term liquidity headroom. This chart shows that at the end of last year, we had recovered to only £2.5 million of bank debt, and that ultimately we didn't require that CL Bills safety net. We have settled our COVID deferred payments and have good and consistent cash generation restored. Therefore, we intend to make an early repayment of our CL Bills during 2022, paving the way for a return to dividend payments for 2022. Turning to page 10 and our group income statement. I've included here a comparison to both 2019 and to 2020 owing to the nature of these reporting periods. Revenue has already been discussed on slide 8. There has been a slight margin erosion since 2019 for two principal reasons. Firstly, the increased level of card payments and online transactions increases our merchant fees. Secondly, we have been very successful at growing our revenue per head through additional experiences and food and drink. This is incremental sales revenue and adds to profit, but is slightly margin dilutive as these elements attract to cost of goods. Costs overall were well controlled in the year. The significant increase in volume has grown the variable base for labour and consumables, but our relatively high fixed cost base generated strong operational gearing. This means that labour as a percent of sales remains well below 20% despite inflation and the increased demands from our COVID security protocols. I've included a line in this P&L of EBITDA after property rental costs. This bridges a rough comparative to pre-IFRS 16 reporting, although the maths is not exact. It uses cash cost of rent rather than the depreciation and finance charge. We are pleased to see this EBITDA of 14.6 million, which we think compares favourably to the 23.6 million in 2019. If you consider that each month of closure represented about a £2 million loss, then 4.5 months of closure is essentially an £18 million swing between the 2 years. Finally, on this P&L, you'll note the £1.1 million reversal of impairment charge, which sits outside the group adjusted PBT. This reflects the write-back of assets that were written down last year because the future cash flows were heavily COVID influenced. Turning to some further detail on page 11. I've set out here the last 30 months of trading. This shows the performance of a pre- and post-COVID business. The second half of last year was extremely strong. There was some cost support of around 1.7 million in respect of the discounted business rates and some 2 to 3% sales growth from reduced rate VAT. But essentially, the business has returned to trading normally. Sales growth of 33.3% has almost doubled our PBT across these two halves, underlying that our business has emerged from COVID stronger than ever. And on page 12, I'll end with an overview of our cash flow and net debt. Again, we'll compare against 2019, and note that this is on an IAS 17 basis, but for cash flow purposes, IFRS 16 has neutral effect. Free cash flow in both periods is very similar, with the shortfall in profit offset by cash conservation actions taken in 2021. There is no dividend in respect of 21, which has allowed the business to mirror the 2019 investment in the existing estate. And bank net debt at the end of the year of 2.5 million is in line with our target of keeping debt at low single digits, and we're delighted that the sales performance has allowed us to get there earlier than originally expected. I'll be pleased to take some questions on the numbers later, but for now I'll hand you back to Graham for our operating review.
Thank you, Anthony. Turning to page 14, I'd like to start with how well positioned we think our business is to tackle the challenges of 2022. The overall economic conditions are very challenging. High inflation and a squeeze on incomes is set to reduce disposable income by 1.5%, although consumer spending is still forecast to grow at 4.4%. However, we've seen a considerable shift in consumer behaviours. Research states that 75% of adults have said that their leisure preferences have altered, and 25% say they plan to spend more on experiences. We also know that customers are more likely to want to spend time with their families and friends and want to do so more locally rather than travelling further afield. TEG is perfectly positioned to capitalise on these trends, and we have demonstrated that with our 29% like-for-like growth. Turning to page 15 and our winning strategy. We are all about experience. We have a fantastic operations team, and we have really raised the game in 2021, focusing on delivering entertainment and value for money above all else. Our strategy is to continue to deliver a first-class customer experience, digitally enabled, in high-quality centres, whilst increasing UK coverage. Our customers' 5 key needs are variety, value, friendly competition, food and drink to enjoy while playing, underpinned by great customer service. We are continually working to deliver those needs. Our strategy is very simple: attract more customers, increase the frequency of their visits, and encourage them to spend more each time they do. In 2021, that resulted in 23% footfall growth versus 2019 and an increase in revenue per head to £15.10. On page 16, we have summarised our focus for delivering our strategy for sustainability. Energy is consistently making headlines at the moment, and we continue the drive to reduce our footprint. We've committed to 100% renewable electricity, and our prices are fixed to September 2024. We are currently in the process of developing our strategy for net zero, and in the meantime, we continue to pursue energy reductions with every repair, refurbishment and new build that we complete. Our new bowling technology has significantly reduced our energy consumption, and we've already facilitated savings of 10%. We are in the process of replacing our gas heating systems where possible with more efficient systems powered by renewable electricity. We're updating our lane and centre lighting with energy efficient LEDs to further reduce our footprint. These technologies provide improved atmosphere and customer experience as well as saving energy. And I'm also pleased to report progress on our diversity and inclusion agenda. 50% of our management teams are now female, and 47% of the board and its direct reports are also female. Turning to page 17 and the customer experience pillar of our strategic priorities. We have made excellent progress in 2021 in developing the customer experience. We now have 24 escape rooms across 12 locations. We have 15 laser tag arenas, 8 centres with karaoke rooms and 3 soft play areas. This increase in the variety of experience helps generate repeat visits and optimises the sales density of our sites. We have fully digitised the recruitment, onboarding and training of our employees. This is not only more efficient, but it helps us select and train our team members to deliver the best in customer service. Along with this, we have focused a rewards and incentive structure to recognise great service and customer delivery. In 2021, we paid out nearly £1 million in staff incentives directly linked to site performance. This helps to deliver a great customer experience and drives retention of our team members. Our customers expect value for money when they visit, and we've worked hard to grow our footfall while retaining our core value proposition. In 2021, we've optimised our yield by balancing demand to capacity, and this has contributed to our strong footfall growth. Core bowling is not subject to the same inflationary pressures as other businesses, enabling us to retain our value for money at an average realised price of just £5.01 per game of bowling, including VAT. Finally, in 2021, we have simplified our menu and enhanced our drinks. Customers have been clear with us that they want simple food to enjoy and share while they play. We've introduced highly popular pizzas and retained our core burgers and platters range with simpler and speedier preparation times. We've supplemented our bar range with cocktails and hot drinks, and the results have been encouraging growth in food and drink of 37%, ahead of the underlying footfall. For 2022, we will continue to drive the sales density of our centres through great service and creating further value for our customers. Turning to page 18 and our digital strategy. Our digital engagement with customers has created a significant platform for growth. Our marketable customer database is now 89% bigger than what it was at the start of 2021, and we've enhanced our understanding of our customers, allowing us to create more targeted marketing. Our aim is to bring the players into the heart of the game from the moment they visit our website. We want them to feel like they are player one each time they visit, and we're building a digital infrastructure that connects the online with the physical experience within the centres. We've increased our social media presence to 224,000 followers and are maximising the use of our platforms to drive engagement. TikTok creates interest and engagement, particularly from our younger players. Instagram has been invaluable in gaining reach and coverage, and Facebook remains a core platform for us to create promotional messaging and generate bookings. This three-tier approach has increased our return on marketing investment during 2021. This year's focus will be to integrate players into the physical bowling experience, and we are looking forward to continuing to bring innovation to our market. Turning to page 19. A high-quality centre is crucial to the enjoyment of our customers, and we continue to invest in best-in-class bowling and experiential activities. During 2021, I've already mentioned that we refurbished 4 of our centres. A refurbishment is an opportunity to step change the customer experience. For example, in Nottingham, we repurposed redundant office space to create a new suite of Houdini escape rooms. We reflowed our bar, kitchen and reception areas to simplify operations, freeing space to introduce our very popular karaoke rooms and fully updated our laser game offering. In Bristol, we also added a brand new laser tag arena, karaoke and Houdini escape rooms. Overall, these refurbishments cost £2.4 million, and we are already seeing returns above our 30% hurdle rate. Pins and Strings is now complete, and we're now improving other elements of the bowling product, such as lanes, ball returns, gutters and scoring systems. Increasing the sales density of our centres is a key objective for us. We know that adding new experiences and activities drives growth in spend and footfall, and we will continue to add these throughout 2022. Turning to page 20 and our estate expansion. We have demonstrated that we have a winning model. Experiential leisure is in growth, and our experience is resonating with our customers. We also know that the market is still undersupplied, creating good opportunities for expansion. During 2021, we have already secured 6 centres that we expect to open over the next 18 months, and we're about to start construction on a new site in Walsall, which was a redundant mother care unit. This is a good example of new properties that are becoming available to us. We can also secure these on similar economics to our existing estate and expect to continue to generate returns in excess of 30%. Our total estate average cost of rent and service charge is only £11.22 per square foot, and we are focused on ensuring that we retain this low fixed cost base. We are continuing to build and develop our pipeline and are confident about adding 4 more centres to the group this year. I'd now like to pass back to Anthony, who will summarise with our views on the outlook for 2022 and beyond.
Thank you, Graham. Turning to page 22. Graham has set out for you why we believe that our business benefits from significant structural advantages. We have long experience in competitive socialising and experiential leisure and are one of the leading businesses in the UK in this sector. Our operational expertise and flexible model means that we are less exposed to inflationary pressures than other businesses. Our product has longevity. People have been bowling in the UK for decades and they are enjoying it more than ever. It also has strong appeal, with easy to engage with gameplay and scope to be enjoyed across generations. we are positioned in the sweet spot of consumer growth. The UK market is also favourable to us. We are a leading player and there remains significant undersupply. A decline in retail is providing excellent space opportunities, and our strong covenant and high footfall make us well positioned to win those properties. We cannot, of course, overlook the wider economic context. For the individual consumer, there is a squeeze on budgets and pressure on spending and disposable income. But bowling is great value, and more a simple and relatively infrequent treat is seen as essential rather than discretionary expenditure. So, despite some tough newspaper headlines, we are confident that we will continue to drive profitable growth in the medium term. The step change is likely to be tempered as foreign travel opens up and consumer spending reduces, but our underlying model is well positioned to continue to thrive and grow over the coming years. On page 23, I'll end with some of the detailed guidance we've included in this morning's announcement. This slide sets out some of the key guidance on modelling for the year ahead. We are expecting the sales growth versus 2019 to temper slightly as we head into the summer, but are still targeting double-digit total growth, likely in the mid-teens. We will pass on COGS inflation in food and drink pricing and anticipate that to be at around 5%. However, we will continue to price our bowling to maximise our yield by centre and don't expect that to create significant price inflation for our customers. We do expect a steady increase in revenue per head as our customers engage more with our entertainment offering. Cost growth compared to last year is inevitable, particularly in labour. However, our labour cost of sales can still be maintained well below 20% as we benefit from the efficiencies of delivering the increased volumes. Our property and energy costs are set to remain relatively stable, albeit there may be some non-electricity related utility inflation towards the end of the year. In terms of cash flow, we anticipate that catch-up maintenance costs will be above our usual 3% guidance, and for a time may even stretch to double that figure to compensate for savings made during COVID. This will be managed based on affordability. With 7 refurbishments and 4 new centres planned, strategic capital is likely to be around 15 million, but despite that accelerated investment, we still anticipate reinstating the dividend, which we'll give an update on in September. Our strategic priorities have already been laid out by Graham, but for ease I have included them on this slide to accompany the financials. Overall, our business is in fine shape and we are looking forward to a very strong year ahead.
I'd just like to say a big thank you to everybody today for joining us. We're very encouraged by the results, and just pass on to Anthony.
Great, no, thank you very much. And as you know, you feel free to give me a shout if you want to pick up in any more detail. I'm always happy to help.
Graham, Anthony, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right corner of your screen. But just while Graham and Anthony take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Graham, Anthony, as you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Could I please just ask you to read out those questions and give response to where it is appropriate to do so, and then I'll pick up from you at the end.
Certainly, and we'll get through as many as we can in the time available. So the first one is, you mentioned M&A. What would you look for to complement the existing business, and how might you fund this ambition?
From our perspective, obviously the core business is bowling, and that's where we would target. However, we're open to any acquisition from the leisure side of things. So we're always evaluating opportunities that come to market. Ideally, we'd like to finance that through cash flow. However, if a group opportunity came along, we would absolutely be talking to shareholders to grow funds that way.
Thanks, Graham. So the second question is, curious to understand the company's plans for its new additional activities, karaoke, laser tag and escape rooms. Are there plans to spin these off as standalone services outside of bowling venues?
If we look at Houdini's first, obviously that is a JV. So we currently have Houdini's growing externally to the temping business itself. So yes, we do have plans from that perspective. However, internally, the karaoke, the Sector 7, from our perspective, we already have bars, we already have kitchens, and therefore where we have spare space, we have 1.4 million square feet of space. So from our view, we can actually roll these out for the next few years internally without encountering overheads from a standalone facility and incurring costs from rentals. So, certain elements we may do from a partnership perspective, but we'll predominantly focus on keeping it internal.
Okay, the next one is linked to that, which is, are customers visiting venues and participating in more than one activity for each visit? For example, a game of bowling and some karaoke at the same time. And is there an opportunity here for a material increase in revenue per head? So the answer to that is exactly why we're adding these activities. But more than just a material increase in revenue per head, we see it as a little bit more incremental. And those activities actually drive frequency of visit. So customers will bowl and see that there's karaoke or escape rooms available, and that will give them an opportunity to visit next month rather than perhaps in 3 or 4 months' time. So it's a combination of frequency and revenue per head, but we don't see revenue per head doubling, because ultimately families have an amount to spend for their weekend treat or for their night out. So the next question is, the returns on refurbished venues is quite impressive. For our models, how many years should we assume between major refurbishments for each venue? So essentially, we are looking to do between 5 to 7 refurbishments a year. And a refurbishment not only refreshes the centre, but it's an opportunity to add new things and new activities. So the cycle is 6 to 7 years. But some of our bigger centres that are very busy will go more quickly and we'll refurbish them more frequently. And some of those where we know that we have slightly lower footfall perhaps will take longer. But generally speaking, you'd expect around a 7-year cycle. There's a question here, how are we dealing with the inflationary pressures across the business? I know leases are protected and our offerings affordable. And I think that's a large point of that. Our business model is such that leases are long term, and therefore we're capped at the impact they have in terms of inflationary pressures. And labour is a relatively low percent of sales compared to other leisure businesses, so it's less than 20% of sales. So as we grow footfall, we can defray that labour cost over a larger footfall and get operational efficiencies. And our ability to pass on price to customers does exist, particularly on food and drink, but our strategy is very much one of driving footfall rather than trying to charge more. Ultimately, we're a low, good value proposition. Next question here is, are redundant retail premises a focus for increased outlets?
Absolutely. I mean, we have 3 current models that we focus on. The first would be our traditional out-of-town retail stroke leisure park. We have launched the second model, which is our high street location. So the Printworks in Manchester is a really good example of that. A much smaller size venue, smaller amount of lanes, 12 to 14 generally, with a heavy footfall populace. And then what we class as a local bowl, which would be more traditional towns, 50 to 60,000 population, and more of a possibly a town that doesn't have an awful lot to do. So we create a facility, a one-stop shop for leisure within that business, backing up, as we've already spoke, with the experiential leisure. So, for us, retail premises, high street locations, it's absolutely broadened the market. So we see great opportunity on the horizon.
So the next question here is around the pipeline, and there's 4 elements to that, which is, what's our pipeline split between acquisitions and new openings? What are the differences in ROI on that? And do we see a reducing return on investment as we effectively go for, we've already done the best locations and are we moving to others? And then finally, the average acquisition and CapEx costs. So I'll try and tackle that all in one, if I may. So As the pipeline stands at the moment, the majority of sites in our pipeline are organic openings, and we've seen an opening up of large box retail space. For example, the new opening we're planning in Walsall is an ex-Mothercare and Peacocks unit, and is one where that retailer has gone out of business, and we're able to take that, and we're seeing a number of those. So of the 7 sites we have in the pipeline for the next 18 months, 6 of those are new openings. In terms of the acquisition cost of those, it's relatively similar to where we've been before, so between £2 and £3 million. But we are very much focused on the return on investment, having a hurdle rate of 30%. So larger centres obviously cost more to build, but they also have a higher sales density and therefore a higher return on investment in absolute terms to cover that increased cost. And they do vary slightly in terms of the way that the landlord incentivises to go in and take that lease and other factors as well. But what we're not seeing particularly is a decline or us finding worse sites to open. We're very, very focused on that hurdle rate, and we'll continue to take locations that meet that hurdle rate. And locations come up all the time. And, we're not necessarily doing the best ones first. We're doing the ones that hit the right returns for us, and ensuring on that. And, it's a question of what properties come up at what moment. So hopefully that answers that question.
Thank you very much. I think you've actually managed to address all those questions from investors. And of course, Graham and Anthony will review those questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Graham, could I just ask you for a few closing comments?
Yeah, I mean, obviously we had a great 2021, and we're on a trajectory for a great 2022 so far. For the first 12 weeks of trading, we're 41% up like for like on 2019. I think the demand for our type of entertainment is stronger than ever. We've had a great start, and we're getting better and better all of the time. We have a strong pipeline, both internally from a refurbishment perspective and from a new site investment. And I think, the longer term structural advantages will underpin our continued growth. And again, I'd just like to thank you for your time today.
Thank you very much.
Perfect. Graham, Anthony, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of 10 Entertainment Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good morning to you all.